You're listening to the Connecticut Real Estate Edge podcast, your source for tips and tricks on building wealth through real estate in Connecticut. You will get the best techniques from leading local experts in real estate and lending. Now, here's your host, Robert Weinberg.
In today's episode, we're going to dive into the ins and outs of refinancing your mortgage. The reason this is so opportune right now is because we've seen a great reduction in the mortgage rates in the last few weeks in anticipation of a federal funds rate cut that's coming up. By the time you're listening to this, it may have even happened. So because we're seeing this reduction in interest rates, anybody that bought a home or got a new mortgage in the last 2 years is really on the table to be looking at lowering their mortgage cost, looking at a potential refinancing, okay? The main reasons that people are going to look at refinancing right now is to be able to drop that interest rate that they took out when they bought their home. I know a lot of people, when they bought their home, they took on a higher mortgage payment than they had anticipated. Their budget maybe was a little tighter than they had wanted it to be. So by refinancing now, they can potentially lower that interest rate, lower that monthly payment, make their budget a little bit more, a little bit easier on a monthly basis, okay? So the purpose of this episode is to help you understand the process of refinancing and also to guide you on determining if refinancing is the right option for you right now. Okay, so let's talk about what is refinancing in the context of a mortgage. So when we're refinancing, what we're actually doing is having your current mortgage paid off and zeroed out, and we're going to replace that current mortgage with a new loan, and that new loan is generally going to have more favorable terms. That could mean a lower interest rate, maybe we're going to drop the monthly payment, or maybe we're going to shorten the length of the mortgage, going from like a 30-year down to a 20-year loan. Okay, so that's really the actual refinance concept and what it means. Now, how it actually occurs is you'll go through the mortgage process, and at the closing, there will be some transactions that occur. Generally, that's going to be the current mortgage being paid off. So there's going to be, after your rescission period, if you have one on a primary home refinance, they're going to have the money wired to pay off your current mortgage. It will be paid in full. If you're refinancing an investment property or second home, then the money will be wired or dispersed right away. But on a primary home, you have to wait 3 business days after the closing for the disbursement. That's called the right of rescission period. And that's how the mortgage gets paid off and then replaced with the new loan. Okay. Now, there are a few different types of refinancing that's out there. And depending on your personal situation, one of these might make sense versus the other. But the main one that I'm focusing on right now is talking about the rate and term refinancing, because that's the one that we're seeing the most often right now. Maybe you got a mortgage that was at a 7 or 8% loan a year or two ago. Now that same mortgage you can get at a 5 or 6% interest rate. Okay, so it would make sense in many cases to pay off that current loan and replace it with that lower rate mortgage, which then gives you a lower monthly payment. That's that rate and term refinance strategy. Another thing that I alluded to was the term change. So maybe you're in a 30-year loan, you want to go down to a 15-year loan. Even though your mortgage payment will go up, your total interest paid will go down substantially because you're paying the home off in a lot less time. So a lot of people do refinance to reduce the term of their loan, and some people refinance to extend the term. Maybe you've been paying on your home for years, you've got that mortgage down to 5, 6, 8, 10 years, but your budget's tight. We can take that mortgage and extend it out. Instead of 10 years, let's extend it out to 20 or 30 years. That's going to lower your monthly payment. That's going to give you more breathing room, which may be really helpful if you had a change in income, retirement, medical issue, anything like that. A lower monthly mortgage can really help out. So that's where the rate and term refi can come in. The next refinancing type I want to discuss is a streamline refinance. Now, a streamline refinance is a type of rate and term refinance, but it's only for government-backed loans. I'm talking about loans that are guaranteed by FHA, the Federal Housing Administration. I'm talking about mortgages that are backed by VA, Veteran Affairs, and last but not least, loans that are guaranteed by the USDA or U.S. Department of Agriculture. Those are the three government entities that I'm aware of that offer streamlined refinancing. So why would you do a streamlined refi? Well, the same reason you would do a rate and term refi. You want to drop your mortgage payment. You want to drop really everything having to do with your mortgage, right? The payment, the interest, the whole 9 yards. Okay, so that's the reason why you would want to do a streamline. But the advantage is you don't have to go through the cumbersome process of an appraisal, of income documentation, et cetera, which a normal rate and term refinance has. So with a streamline, really, they're just looking at your mortgage history and, checking a few boxes to make sure that you meet the criteria, and then you get the loan. So there's no appraisal generally required on these type of loans. Not always, but most of the time, no appraisal required. There's no income documentation required, so you don't have to re-verify your job, how much you make, your debt to income, all those things that can go into a refinance underwriting and cause issues or problems. We don't have to deal with that on a streamlined refi. So if you're holding an FHA, USDA, or VA loan, it's a good time to be looking at a streamlined refi. And there are certain criteria you need to meet to make sure it's going to benefit you. The VA has a 36-month recoup. FHA has some calculators as well. And generally, you want to be lowering your interest rate at least 1/2 of 1 point or more to qualify for a streamlined refinance. Okay, so that's the gist on that. So we talked about those different rate and term options, but cash out. Where does cash out refinancing come in? I saved the best for last. This is the one I'm most passionate about. So on cash out refinancing, you can replace your current mortgage with a new mortgage that's bigger than your current one, and you're going to be able to pocket the difference in cash minus any closing costs that you pay. So for example, if you owe $100,000 on your mortgage, but you have some equity in your home, you may be able to refinance that mortgage for $150,000, even though you only owe $100,000. That difference minus closing costs is the amount of proceeds that you can receive, and you can use that money for whatever you want. Because it's loan proceeds, it's currently not taxable in the U.S. tax code. So there's a big advantage to getting money from a cash out refinance versus selling the home or getting it somewhere else that may have taxes or other things that are not as desirable as getting it through this method, okay? Most people that do a cash out refi, I see them using the money for paying off debt, especially high interest consumer debt. I see business owners using it for capital to expand their business. I also see a lot of people right now using it for home improvements, renovations, repairs on their home. And I've seen some investors use cash out refi to actually put the down payment on a new property or buy a new property completely outright by taking out enough money to do that. So there's a lot of different things you can use the money for, but there's not really a limitation. So if you have the equity necessary to do this, then cash out refinancing may be part of the strategy. Sometimes we'll combine both. We'll do dropping your rate and getting you cash out at the same time. Okay, so that's a double benefit type of refi. If you put a big down payment or you bought your home several years ago and it's gone up a lot, this might be something that you can look at now. But generally speaking, for the cash out refi, you're going to want to be in your home at least 3 to 5 years minimum, because you have to have 20% or more in equity unless you're a veteran to take advantage of these options of these programs. Okay, so if you're someone that just bought your home a year or two ago, you put little to no money down, cash out refi probably isn't going to work. But if you made a really large down payment or you've built quite a bit of equity over several years, like I said, 3 to 5 years or more, that's when we can start looking at these strategies for you on the cash out. The last thing I'll touch on the types of refinancing is an adjustable to a fixed rate refinance. So this is when maybe you have an adjustable mortgage, but things are fluctuating, things are changing. You want to lock in a long-term fixed rate so that you don't have that uncertainty, you don't have that risk. That's where a ARM to fixed refinance can come in. It's going to convert and pay off your current adjustable rate mortgage with a new mortgage that's going to be a fixed rate. Many years ago, when adjustables were more popular, we would have people refinance into them, but adjustable rates just haven't been popular lately. They really haven't. There hasn't been a benefit to taking an adjustable rate. So this is something that we don't really see often now, unless it's someone that took the adjustable many, many years ago where they were more opportune, made more sense, okay? So let's talk about when refinancing makes sense and how to evaluate your current situation to know if you should move forward or not. So what you want to do is you want to compare your current interest rate on your mortgage with what the current market rate is. And you also want to assess how long you plan to stay in your home. So to compare the market rates, obviously you can see like Google average 30-year mortgage rate, but you should have an advisor or someone that you can collaborate with and get an idea of where the rates are, get an idea of where things are. If you don't have someone like that, reach out to me. Let me be your mentor when it comes to mortgage rates and getting the information that you need. So once you figure that out, you can determine where you're at. Like if you're at a 7% rate and the going rate's 6.75, not a big difference there. Not to say it won't make sense, but not a big difference. The general rule of thumb is you have to be saving at least a half a point or more to where it becomes like a major idea to look at refinancing. If you're not going to save a half a point, it's not that it won't make sense, but it's just not as much of a no-brainer. Once you're saving a half a point or more, then refinancing becomes very, very compelling to move forward with. Okay, so compare your current rate to the market. If it's a half a point or lower in the market than what you've got, move to the next step. Look at potential refinancing options at that point. How long do you plan on staying in your home? This is a big one because, as we'll talk about, there's costs associated with refinancing your mortgage. Those costs take time to recoup, and they take sometimes several years to recoup. So the rule of thumb is if it's going to recoup in less than 36 months, then that's great, but you have to stay in the house for at least 36 months to make it worthwhile, right? So if you're taking a refi that's going to take you 2 years to break even on, but you move in a year, you didn't break even. You just spent money you didn't need to. You just wasted money in that refinancing process. So assess how long you plan on staying in your home. And generally, if you're not going to stay there for at least 2 to 3 years or more, then it does not make sense to move forward with the refinance, okay, at all, regardless of those benefits. Closing costs, fees, we have to calculate that break-even point we were just talking about. So it's figuring out how much is it going to cost you divided by the savings that you're going to get, all right? Also understand that you're going to save more money by consolidating debt into your mortgage. If you're doing a cash out, you're going to pay off high interest debt. That can be a big thing to help you and help your monthly budget, all right? Once you know how long it's going to take to recoup the cost, analyze how long you're going to stay in the home, like we said, and make sure that it makes sense. Make sure that if it's going to take you 4 years to recoup, hey, that's a bit long. Do you really see yourself staying in the house for that long? All right. Scenarios where refinancing might not be worth it. Well, there's a lot of cases where the rate might look good, but there's a huge fee or cost associated with that rate. So you really need to look close at that and see if you can break even on it. A lot of the time you can't, and those high closing costs will make it just not beneficial at all to move forward with the refinance. Another one is if you plan to move in the near future, which we said. And then the last one is if your current mortgage terms are already favorable. Maybe you already have a good interest rate, a good scenario, and it's not worth moving forward with a refi, then just stick with where you're at, stay where you're at. You don't have to do anything at all, but stick with your current mortgage. We need to determine your goals for the refinancing process. So clarify why you want to refinance. Lower payment, cash out, shorter term. What's the reason? Then the next thing you want to do is get an idea of your credit, right? Especially if you've got issues. Look at that before you go in for refinancing, because the better your credit is, the better terms you're going to get on a mortgage. You want to understand and have a mentor, someone that can help you compare different lenders' offers, especially with refinancing. You want to make sure you're getting a great strategy, but also a good terms on the mortgage that you're getting, not something where you're being taken advantage of, the wool's being taken over your head, or you're not getting the best deal possible, okay? Once you've determined what lender you're going to work with, then you're going to actually move forward with the application, submit your documentation like your income, identity, etc., okay? At that point, we're going to have the mortgage underwritten. We're going to have the appraisal done if necessary. And we're going to get all the documents completed with underwriting. That can take a couple of weeks, start to finish. And then you're going to do the closing. Before the closing, we'll, of course, review all the final loan terms, go over all the numbers with you top to bottom. And then if you're refinancing a primary home, you'll have a 3-day rescission period, or a 3-day period after closing where no money will be dispersed. And that's the point where you'll have a chance to double verify all the documents, review again the final loan terms, and you'll have the opportunity to cancel or rescind that refinance during that 3-day period if you choose that it's not in your best interest and you don't want to move forward. Okay? Now, some common pitfalls and things to understand about refinancing and how to avoid some of these pitfalls. I'd say the biggest pitfall I see is not considering the total cost of the refinance. There's two different parts to the closing costs. There's loan costs and there's other costs. Now, the other costs are generally going to be your recording fees, your taxes, and your home insurance. So no matter what mortgage company you use for your refinance, those other costs should be the exact same no matter what, because those are based on your property tax and insurance. The main costs that you really want to be looking at are the loan costs, or the costs that are on the left-hand side of the loan estimate form that you'll receive. Now, these are the costs that are hard costs to actually manufacture your mortgage: underwriting, processing, title charges, title insurance, document prep, that sort of thing. These are the costs that can really add up when they're adding on points and extra fees to buy the rate down. And that's really where you want to see the cost as low as possible. Just because you're getting a good rate doesn't mean that it's worth the cost to get that rate. And I've seen some cases where total cost can be $10,000, $15,000 or more just to get a rate that doesn't even save you that much money. So you need to look at the whole picture, upfront cost and long term, and what you're going to save to really do that break-even analysis that we were talking about. Don't just focus on the interest rate. Now, as far as shopping around, some say get with a lender or a few different lenders. I actually say work with a mortgage broker, somebody that has access to dozens or hundreds of different lenders like myself. I have 147 lenders as we're speaking right now at my disposal. I can shop your loan and actually look at the market with all these lenders and what they're offering with just one credit check. So we can go out into the market and put ourselves in your shoes and see what the best terms are without having to talk to dozens of different lenders and go through the whole process, providing documents, this and that. Okay, so if you're going to shop around with a few different lenders, that's okay, but I recommend aligning with a mortgage broker or someone that has a lot of the different relationships that can do that shopping for you. Okay, make sure it's somebody that you trust that has really, really good reviews. Another pitfall that I've seen, not so much lately, but a few years ago, was refinancing too often. You know, some people would refinance literally every 6 months to get money out of their home. We don't see it as much anymore because of the situation with interest rates, but we definitely saw a lot of that going on when the interest rates were on a downward trend, okay? So let's wrap up here by talking about if refinancing is right for you. What are your goals? Can you afford the closing costs? Although they'll be rolled into your mortgage, make sure you've got the equity to be able to afford those in the new loan, and how long you plan on staying in your property. I have a program I use called HomeBot. All my clients get a complimentary subscription to HomeBot, and that will keep you up to date on what's going on with interest rates as well as the value of your home on a monthly basis. So I do recommend you consult with your mortgage advisor or financial planner on these topics that we're discussing. If it's something that I can assist you with, I do put together one-on-one personalized refinancing plans. You can reach out to me by call, text, or private message. I hope that today's episode has given you insight on the refinancing process and helped you feel empowered on moving forward with a new refinance for you and your particular needs. Until next time, thanks for listening. Take care.
Thanks for listening. If you have questions about the information we've covered or would like to discuss mortgage financing for your situation, you can reach Robert Weinberg by visiting www.robgw.com.